45%. That's how much silver lost in 48 hours, not 48 days. Not 48 weeks, 48 hours. If you had $100,000 in silver on Thursday morning, by Monday afternoon, you were looking at $55,000, nearly half your investment, gone. And this wasn't some speculative crypto token or a meme stock pumped on Reddit. This was silver, one of humanity's oldest stores of value, a metal that has functioned as money for 5,000 years. But here's what makes this story truly extraordinary. On Tuesday, February 3rd, the very day I'm recording this, gold posted its biggest single-day rally since 2008, the financial crisis. Silver surged over 9% in a single session. Mining stocks that had been decimated just 24 hours earlier suddenly exploded higher. The same markets that were in complete freefall on Monday staged one of the most dramatic reversals in modern financial history on Tuesday. And the question that every investor holding precious metals needs to answer is this: was Monday the bottom or was Tuesday the trap? Because the difference between those two scenarios could be the difference between a generational buying opportunity and catching a falling knife. And what I'm about to walk you through is exactly what happened, how it happened, and what the biggest banks on Wall Street are now saying about where these markets go next. So, let's start at the beginning. Thursday, January 29th. Silver touched $121.60 per ounce that morning. If you're wondering whether that's a typo, it's not. 121. To put that number in perspective, just 18 months earlier, silver was trading around $25. We're talking about a rally of nearly 500%, the kind of move that creates generational wealth, the kind of move that gets people on social media calling themselves investment geniuses for buying at what they thought was an obvious bottom. Gold wasn't far behind in its own historic run. At its peak last week, gold touched $5,594 per ounce. That represents a doubling from its levels in early 2024. Central banks around the world were accumulating gold at a pace not seen since the 1970s. Retail investors in India were camping outside bullion shops before dawn, waiting hours for their chance to buy. In Sydney, Australia, one gold dealer reported queues of 1,000 people forming every single morning. 1,000 people every morning waiting to buy gold. This was mania, pure, unadulterated, textbook financial mania. And like every mania throughout financial history, from Dutch tulips to dot-com stocks to subprime housing, it ended, and it ended badly. The trigger was a name that most Americans have never heard of. On Friday morning, January 30th, news broke that President Trump had nominated Warsh to succeed Jerome Powell as chairman of the Federal Reserve. For the average person watching this, that might sound like inside baseball. Some bureaucrat replacing another bureaucrat. Why should you care? Here's why you should care. Kevin Warsh served as a Federal Reserve governor from 2006 to 2011. He was there during the global financial crisis. He helped design the emergency programs that kept the banking system from collapsing. And during that entire period, he established himself as what markets call a hawk. A hawk is someone who prioritizes fighting inflation over stimulating economic growth. Someone who believes the Federal Reserve has gone too far in its money printing. Warsh has publicly stated on multiple occasions that the Fed's balance sheet is, and this is his exact phrase, trillions larger than it needs to be. Within minutes of that nomination hitting the news wires, traders around the world began frantically recalculating their assumptions. You see, for months, the entire precious metals rally had been built on a very specific thesis. The thesis that the Federal Reserve would continue to ease monetary policy, that interest rates would continue to fall, that the dollar would continue to weaken against other currencies and hard assets. This was what professionals call the debasement trade, the bet that paper currencies are losing value, that governments cannot be trusted to maintain the purchasing power of their money, and that hard assets like gold and silver are the only true protection. Warsh's nomination challenged that thesis at its core. Here was a potential Fed chairman who had openly criticized quantitative easing, who had resigned from the Federal Reserve in 2011, at least partly in protest of loose monetary policy, who had repeatedly and publicly argued that the central bank needed to restore what he calls monetary discipline and shrink its swollen balance sheet. Within hours of the announcement, The dollar index spiked higher, Treasury yields rose, and the entire intellectual foundation that had supported the precious metals rally began to crack. But here's where understanding the mechanics becomes absolutely critical. The Warsh announcement explains why selling started on Friday. It does not explain the cascade that followed, because what happened over the next 72 hours was about far more than one Fed nomination. It was about structure, it was about leverage, and it was about the hidden fragility lurking beneath one of the most crowded trades in global financial markets. To understand the true mechanics of this crash, you need to understand something called margin. When traders buy gold or silver futures on an exchange like the COMEX, they don't put up the full value of their position. They put up what's called initial margin, typically around 5 to 10% of the contract's total value. This leverage is what allows traders to make outsized bets with relatively little capital. A trader with $100,000 can control $1 million worth of gold. If gold goes up 10%, they haven't made 10%. They've doubled their money. But leverage is a double-edged sword, because if gold goes down 10%, they haven't lost 10%. On Friday, when gold dropped nearly 10%, traders who were leveraged 5 to 1 didn't experience a 10% loss. They experienced a 50% loss. Some of them experienced total account wipeouts. And here's the brutal part. Their brokers didn't call to ask what they wanted to do. The computers simply sold their positions automatically. No negotiations, no second chances. That's how margin calls work in modern markets. They're executed by algorithms in milliseconds. By the time you see the notification on your phone, your position is already closed. And then over the weekend, something happened that made everything exponentially worse. On Saturday morning, the CME Group, which operates the COMEX exchange, announced emergency increases to margin requirements. Silver margins were going up by 36%. Gold margins were going up by 33%. The changes would be effective immediately on Monday morning. Stop and think about what this means in practical terms. Anyone who had somehow survived Friday's bloodbath, anyone who had scraped through the 10% drop in gold and the 15% drop in silver, now needed to come up with additional cash over the weekend just to maintain their existing positions. For silver, that meant an extra $7,500 per contract. And this announcement came on a Saturday, when banks are closed, when wire transfers don't process, when there's essentially no way to move money quickly enough. Monday morning's opening was a slaughter. Silver crashed below $71. At its low point Monday, silver had fallen from $121 to $71. That's a 41% decline in less than 3 trading days. Gold fell to $4,400, down more than $1,000 from its all-time high. For perspective on how historic this was, you have to go back to the Hunt Brothers catastrophe of 1980. That's the last time silver experienced a decline of this magnitude. More than 4 decades ago, an entire generation of traders has come and gone without seeing anything like what happened last week. Now here's where this story takes an unexpected turn. While the futures markets were imploding, while the paper price of gold and silver was in free fall, something very different was happening in the physical markets. And understanding this distinction is absolutely crucial for making sense of what comes next. Let me take you to West 47th Street in Manhattan. Between 5th Avenue and 6th Avenue, there's a single city block known as the Diamond District. This is ground zero for precious metals and jewelry trading in the United States. 2,600 businesses packed into one stretch of sidewalk. 33,000 people employed in those businesses. An estimated $400 million in transactions flowing through this block every single day. This is where physical gold changes hands in America. Not paper contracts, not futures, actual metal that you can hold in your hand, weigh on a scale, and walk out the door with. And on Monday morning, the Diamond District had a crisis on its hands. Multiple dealers stopped buying entirely. Refineries closed their windows. Major bullion shops posted signs saying they were unable to quote prices until further notice. Because how do you quote a price when the commodity you're trying to price is swinging 25% in a single trading session? How do you tell a customer who walked in the door when gold was at $4,800 that you'll give them $4,400, knowing that in an hour it might be $4,200 or $4,600? Or anywhere in between? One dealer who has worked 47th Street for more than 30 years described the scene to financial media as, and I'm quoting him directly, absolute pandemonium. He described lines of people trying to sell at prices from 3 days ago, people clutching gold coins and jewelry, desperate to liquidate, not understanding why the price on their phone didn't match what the dealer was offering, and the dealers themselves had run out of cash. They'd been buying throughout the rally, building inventory, and now they couldn't liquidate that inventory fast enough to meet the wave of people showing up to sell. Here's the part of this story that should really make you pay attention. The spread between the paper price of gold, the price you see quoted on financial news networks, and what you could actually receive for physical gold on 47th Street, that spread widened to levels not seen in decades. On paper, gold was at 4,400. In reality, if you walked into a dealer in the Diamond District on Monday afternoon trying to sell a physical gold coin, you might have gotten 4,200, maybe less. The paper market and the physical market had completely disconnected. This disconnect reveals something fundamental about how precious metals markets actually operate. There are two separate markets for gold and silver, the paper market and the physical market. The paper market is where futures contracts trade. It's fast, it's liquid, it's dominated by algorithms and leveraged speculators who may never actually touch an ounce of physical metal in their lives. When margin calls hit, the paper market collapses because computers execute sell orders regardless of fundamental value. The algorithm doesn't know that gold has been a store of value for 5,000 years. It only knows that the account is below its margin requirement and the position needs to be closed. The physical market operates differently. It's composed of people and institutions who actually want to own the metal. Central banks building their reserves, jewelry manufacturers who need gold and silver for their products, individual investors who want to hold something tangible, something that doesn't depend on a counterparty keeping their promise. When the paper market crashes and the physical market refuses to follow in lockstep, you get a gap, a disconnect. And disconnects in financial markets create opportunities. That disconnect began closing on Tuesday. Gold opened higher and never looked back. By the end of Tuesday's session, gold had rallied more than 5% from its Monday lows. That represents the biggest single-day gain for gold in 17 years. You have to go back to the depths of the 2008 financial crisis, when the entire global banking system seemed on the verge of collapse, to find a day when gold moved this much in a single session. Silver's rebound was even more dramatic, a 9% gain in one day. Mining stocks that had been left for dead on Monday, companies like Fresnillo and Newmont and Pan American Silver, suddenly surged by double-digit percentages. The iShares Silver Trust, which tracks physical silver holdings, jumped over 13%. So what changed between Monday and Tuesday? The fundamentals didn't change. Nothing happened over those 24 hours that altered inflation expectations. Nothing changed the trajectory of government debt. Nothing changed the central bank buying patterns that have been supporting gold for years. What changed was positioning. The speculators got wiped out. The leveraged traders got margin called. The weak hands, the people who bought silver at 110, hoping to sell at 150, they got shaken loose. Brutally, completely. And once that forced selling exhausted itself, once the margin call cascade ran its course, the buyers who remained stepped in. Central banks that had been accumulating gold throughout the rally saw prices 15% below their recent highs. Family offices that had been waiting for a pullback got their pullback. Long-term investors who actually want to own physical metal, who don't face margin calls, who don't get stopped out by algorithmic selling, they started placing orders. And the major Wall Street banks, the institutions whose research reports move markets and shape how trillions of dollars get allocated, they didn't change their tune. If anything, they became more bullish. JP Morgan released updated research this week, maintaining their year-end target for gold at $6,000 per ounce. That implies roughly 30% upside from current levels. UBS published a note on Saturday, keeping their mid-year target at $6,200. They specifically wrote, and I want you to hear this quote, "Since Warsh hasn't demonstrated the same credibility as Volcker, we don't believe this is the end of gold's bull market." They're comparing the current situation to Paul Volcker, the Fed chairman who crushed inflation in the early 1980s by jacking interest rates above 20%. UBS is saying Warsh isn't that guy. The comparison isn't even close. Deutsche Bank sees gold reaching 6,000. Citigroup raised their silver forecast to $150 per ounce. These are not Reddit commenters with anonymous accounts pumping their bags. These are institutions managing trillions of dollars in assets, staffed by analysts who do nothing all day but study these markets. And they're saying that this correction, as violent and historic as it was, does not change the fundamental case for owning precious metals. Here's why that matters. The reasons people buy gold and silver haven't changed since last Thursday. Inflation remains above the Federal Reserve's 2% target. Government debt stands at $28 trillion and is growing by roughly $1 trillion every 100 days. Central banks around the world continue diversifying away from dollar-denominated assets at a pace not seen since the Nixon administration ended the gold standard in 1971. Geopolitical tension, from trade disputes to regional conflicts, to the ongoing restructuring of global alliances, shows absolutely no sign of easing. Kevin Warsh, whoever he turns out to be as Fed chairman, doesn't change any of that. One appointment doesn't reverse decades of monetary expansion. One nomination doesn't suddenly make $28 trillion in debt sustainable. One press release doesn't eliminate the reasons why China and Russia and India and Turkey and dozens of other countries are accumulating gold reserves as fast as their central banks can acquire them. What Warsh's nomination did was trigger a reset, a violent, painful, historically unprecedented reset, but a reset nonetheless, and resets create opportunities. Consider what's actually happening in the physical market right now. Demand at coin dealers has reportedly increased since the crash, not decreased, increased. People who were priced out when silver was above $100 per ounce are suddenly interested again at 80. Jewelry manufacturers who were struggling with profit margins when gold was above 5,500 are placing orders again at 4,700. Sovereign wealth funds that couldn't justify adding to positions at all-time highs are reevaluating their allocation models. This is how bull markets actually work. They don't move in straight lines. They surge, they correct, they consolidate, and then they surge again. The corrections shake out the speculation. They punish the leveraged. They create better entry points for long-term capital, and then the cycle repeats. The question, of course, is whether this particular correction is over. And I need to be honest with you here, it might not be. Some market analysts are using the phrase dead cat bounce to describe Tuesday's rally. The concept is simple. Even a dead cat will bounce if you drop it from high enough. The idea is that prices often rally sharply immediately after a crash, creating the illusion that the bottom is in, before rolling over and making new lows. One research firm has placed the probability of a major long-term top having been made at 80%. The argument supporting this bearish view centers on Kevin Warsh and the potential trajectory of the dollar. If Warsh actually implements the policies he has been advocating for years, if he genuinely shrinks the Federal Reserve's balance sheet, if he keeps interest rates elevated longer than the market currently expects, if he restores what he calls monetary discipline to the central bank, the dollar could strengthen substantially from current levels. A stronger dollar is historically negative for gold. It raises the effective cost for international buyers. Since gold is priced in dollars, it increases the opportunity cost of holding an asset that generates no yield when treasury bonds are offering attractive returns. It undermines the debasement trade narrative that drove so much of the recent rally. There's also the technical damage to consider. When silver drops 45% in 3 days, it doesn't simply bounce back like nothing happened. The chart patterns that technical analysts use to identify trends get demolished. Support levels that were supposed to hold get broken. Confidence among short-term traders evaporates. New patterns need to form. New support levels need to be established and tested. Some analysts expect precious metals to trade sideways for 2 to 3 months before the market can confidently determine whether this was just a violent but temporary correction or the beginning of something more serious. So where does all of this leave you? If you already own physical gold or silver, the events of the past week probably haven't changed your fundamental thesis. You bought these assets for reasons that still exist. You own something tangible that doesn't depend on a counterparty honoring their obligations. The volatility was painful to experience. Watching 40% of your silver position evaporate on paper in a matter of hours is not pleasant, but paper volatility in an asset you plan to hold for years or decades is different from realized losses. If you didn't sell at the bottom, you didn't lock in those losses. If you've been waiting for an opportunity to buy, this pullback may be exactly what you've been waiting for. The major banks think gold is headed significantly higher from current levels. Their price targets suggest 20 to 30% upside over the next 6 to 12 months. But they also acknowledge that the path higher won't be smooth. There will be more volatility, more headlines, more days that test your conviction. If you're trading with leverage, if you're using futures or options to make leveraged bets on the direction of precious metals, please understand what you just witnessed. Careers ended this week. Accounts that had tripled or quadrupled throughout 2025 got wiped out in 48 hours. Leverage magnifies gains, but it can destroy you even faster when markets move against you. The margin call doesn't care about your thesis. It doesn't care about your long-term view. It only cares about the price right now versus the price when you entered. I want to be completely clear about something. I'm not telling you to buy. I'm not telling you to sell. I don't know your financial situation. I don't know your risk tolerance. I don't know your investment timeline. I don't know any of the factors that should go into a major investment decision. What I am doing is showing you what the data reveals, what the institutional analysts are saying, what the mechanics behind this historic week actually looked like beneath the surface. The precious metals market just experienced something that happens maybe once every 15 or 20 years, a complete reset of speculative positioning, a clearing out of leverage, a return to more sustainable price levels after an extraordinary, some would say euphoric. At the same time, the fundamental reasons investors own gold and silver remain as relevant as they've ever been. Inflation persists. Debt accumulates. Geopolitical uncertainty intensifies. The institutions with the most resources and the deepest analytical capabilities are maintaining their bullish long-term forecasts. Whether that combination represents an opportunity or a danger depends on your perspective. It depends on your time horizon. It depends on your ability to tolerate volatility without making emotional decisions at the worst possible moments. What I can tell you with certainty is this: the next few months in precious metals are not going to be boring. After a week like this one, after the kind of volatility that breaks records going back 4 decades, markets do not simply return to calm overnight. There will be more dramatic moves, more surprises, more moments that feel like the end of the world or the opportunity of a lifetime. Sometimes both in the same trading session. I will be covering all of it here: the data, the analysis, the mechanics that most financial media either doesn't understand or chooses not to explain. If that's valuable to you, you know what to do. I'll see you in the next one.